in today's lesson, we will be talking about the market dynamics of hot stocks. I believe this is an evergreen piece of content which should last the test of time. So it's very important to understand this lesson, and especially when it comes to hot stocks, because at any given year, even if it is a bear market and the overall market is going down, there is always a hot stock which is all over the media and it is bringing in a lot of investors. And what happens? Most of the time, generally speaking, most people get hurt by these type of assets. But at the same time, we can definitely profit from them. And, you can make a lot of money extremely fast from them because they're moving really, really quick. So you don't want to completely stay away from them, but you have to be careful because you're playing with fire whenever you're investing in these hot stocks. So today we're going to be using NVIDIA as an example. If we think about it overall over the last year or so, NVIDIA has been the name, it has been the investment, which everybody has been talking about. Right now, the whole narrative is all about AI and technology and all of that. And the leader in the space is NVIDIA. It's kind of like, the picks and the shovels of the industry. Because with AI, you need these types of computer chips. Otherwise, it's just not possible. Okay, so let's jump into NVIDIA and just take a look at the chart first. So overall, NVIDIA has been a great investment. It's been one of the greatest investments since 2016 at the bottom down here. And I've just drawn in a bit of a channel. So the green line is kind of like where it seems like it likes to bottom out. And the red line is more of like the resistance area where it seems like it kind of usually gets near the top and it could be potentially expensive. And so the green is, the opposite of that, where it's cheap. And you could draw in the middle. You could draw in the middle roughly, something like this, and say that is like fair price. So something along the lines of that. Okay. Now, often with hot stocks, they have some sort of narrative behind them, which is exciting the market, which is bringing in more and more investors. And the story with Nvidia is quite easy to understand. The tricky part, though, is Nvidia in this case is actually backed by proper results. Like the company, their revenue is just going through the roof, their profit is going through the roof. So all of the numbers actually, they're going up. So stock price is going up, all the numbers are going up, and the story makes sense. But sometimes, often, it can go up faster than what is actually the true value. And I'm not saying Nvidia is overblown. I'm not saying like, hey, this thing has to crash, but there is a potential for it to crash. And you can swap this with kind of any name. It's tricky with Nvidia because the story is strong and the numbers is strong. But at the same time, there are certain market dynamics which, even if that is the case, think about if you were an investor down here, like at $10, and now it's even after it going sideways for quite a while, is at $100. That's a 10x. Okay. So we need to be thinking, what are these guys thinking? Okay. Because it's like the smart investor versus the novice trader. It's always these two going head to head. There is usually a winner and a loser, and the smart money, generally speaking, they're smart money for a reason. That means they win. Okay. And the novice trader, sadly, they lose. So let's get back to the chart and break it down so we can understand it. So we've got these two green lines. Right now, if we're looking at it and just looking at it like we're a 5-year-old child, we say we're closer to the red line. So that's evidence that we're closer to expensive. Now, if we go to 2023, we'll say, hey, the price was $11. From this area, which I think is very important, up until the peak, the price had gone up 1,200%. Okay. And now if we draw it down to the recent correction, it was down to 659%. That's at around $88 a share. And if we go to roughly where we are today, it's 834%. So even after the correction, it has gone down quite a lot. Now, with investing in stocks, these stocks, they go through cycles, different stages, we often call them, because it has to do with the psychology of both of those players we were talking about, the smart money and the novice trader. And sometimes you like to call them even the dumb money. Okay. So after a major correction like this, after a major correction like this, so this is from 2021 down to 2022, September 2022, we went down quite a lot. Like we went from expensive all the way down to cheap. And that's like a 68% correction. 68%. Think about that for a second. The biggest, one of the biggest corrections on the S&P 500, the index in 2008 financial crisis was 55%. So it makes sense that these type of stocks can correct pretty damn hard, and they should be able to correct more. It makes sense that they'll correct more because they're not diversified. They will correct more than something like the S&P 500, which is extremely safe. So what I want to say is like, the main point of this video is like, if you're getting extremely bullish on NVIDIA up here at this range, where we are now, we're going sideways now, that may not be the smartest thing. Like, I do think you should have a position of some sort because it is a hedge against the future, because if AI takes over everything, there's going to be probably this weird transition period where people are losing their jobs. I think long term, it turns out to be a world of abundance, but there's that transition period where the world has to adapt to that, and it can take a little while. So I do like to invest. If I had nothing, I would want to have an allocation to NVIDIA here at these highs if I had nothing. But if you're a smart investor and you had already invested near the lows, in 2022, and you're up, 1,000%, what would you actually be thinking today? Okay. What would you be thinking today? If you are that guy that has been holding since then, that means your investment in that company is up like 10x. Okay. It's up like 10x. That's only if you're in 2023. You could have been invested since, some people might have been invested since 2016. All right. But let's just think about this guy that's had invested only in 2023. It's not that long ago. So imagine if you were smart enough, and I wasn't smart enough, my position in NVIDIA, it's not it's not up that much. So my position is 1.82%. It's only up 319%. And now it is 4.66% of the portfolio. So, because it's grown by 319%, that means it takes up a larger portion of the portfolio today. So it's 4.66%. I'm happy with that. I don't want to take any more profits, and I don't want to increase the size, because in some of these other things, like these indices that we have, SPXL, and a big one here at TQQQ, there is NVIDIA in these as well. So the overall position of NVIDIA in the portfolio on eToro is not just that individual position of that NVIDIA at 4.66. It is more, it's larger than that. So it should be, it should be at least 5% if you double check the math exactly. But yeah, it's rough. It's bigger than 4.66. All right. So now imagine if you're the guy who invested in 2023, and it's actually been quite easy, like the end of 2022. It's actually quite easy because that wasn't that long ago, right? It's not that hard to hold for 3 years. So imagine if you're smart and you could predict all this stuff and you made a 10% allocation to NVIDIA down here at the bottom. And then you will be thinking, like in that moment, like you'll be thinking, all right, so what is my expectations with this stock? Coming up here is kind of like your wildest expectations did get hit. And now it's grown by 10x. So if you had a 10% allocation to NVIDIA, it kind of swallowed your whole entire portfolio. So it could grow so large that it might be more than 50% of your whole entire portfolio now. It might be the majority of your portfolio. So if that's the case, you actually face a very tough dilemma, because one mindset is like, let your winners run. And, you don't want to sell your winners. And Warren Buffett is famous for that. He made that position in Apple, and he just kept on holding. He kept on holding, and he allowed it to grow to 50% of the portfolio. In this case, it is most likely, if you put 10% in NVIDIA, it will be more than 50% after just like 2-3 years. It's pretty wild. So if you're that guy, you're thinking, all right, do I hold and let it run even more? Or do I secure my future and just lock this in? Because I've kind of hit the lottery in a way. And if I lock this in, I'm kind of done now for the rest of my life. Like, because if you compound at like 11% or 10%, you thinking about like the gold standard, the S&P 500 for a very, very long period of time, you make a lot of money. Then if you can outperform the S&P 500 and you think you can make 15% or 20% over a long period of time, you make even more money and the results are insane. If you double the compound rate, you do not double the results. They go up exponentially. It's mind-boggling how big it is. Now, when you make really, really fast gains in a short period of time and you front load that all at the beginning, now you can compound with larger money for the rest of your life. So you can kind of like, you're kind of in that position if you're thinking smart, like, dude, I just made that much money that quickly, way faster than my wildest expectations. I'm not going to be greedy here. I should probably trim the position. Then you trim the position, you lock it in. And if you're like an actual portfolio manager, you're doing two things. You're securing your finances, you're securing the fund's finances, and you're locking in your reputation pretty much for the rest of your life. Because and you could play it more greedy, but you're taking on more risk in that instance. Okay. So I believe most investors, most smart money, even if they are truly, truly bullish, and they may be even more bullish fundamentally here, all right? Like right now in this moment, it's 2025, right now in this moment, April 2025, they might be more fundamentally bullish on NVIDIA than they were here, but they're up on a crazy amount. So this is how we get into the market dynamics. So even if they are more bullish today than when they took the investment in October of 2022, they may be thinking, because they've made so much money, hey, I should probably take a little bit of chips off their table. Okay. Now, let's just say they invested 10% of their portfolio down here, and then that grew into like it went up 10x. So if they trim off 1%, right? So they had 10% allocation in their portfolio, and if they just trim off 1%, so they hold that 9, but that 1% is so massive now. So that's how their sell orders could be so much larger because they've grown so big in size. So when you think about supply versus demand, very simply, supply versus demand is the only thing that actually matters when it comes to a stock price. Stock prices all come down to supply versus demand. If there's more money that buys than sells, the price will go up. If there's more dollars selling than there are buys, the price will go down. If it is equal, that means everybody transacts and they just swap at that price. So the price holds at the same level. Okay. So now if we zoom in on the most recent cycle, you can kind of see what's happening. The story to me is, here's like the first stage where there is an inverted head and shoulder down here, an upside down head and shoulder pattern, which doesn't really matter. Like the pattern doesn't really matter, but you can see the price kind of went sideways. It went down to hit the low and kind of went sideways in this range for quite a while at the lows, which means that is probably the smart people buying at the lows, because that's what the smart investors do, which means there has to be someone selling. So who are the people selling at the lows? Because they have to buy from someone. So they're buying from, sadly, the dumb money. Who were the dumb money? The dumb money were the people buying at the top here. So when it was pumping, the dumb money comes in at the highs because that's when it's all in the media, right? That's when they're getting hit and bombarded by it, like, hey, this is the best performing stock ever. There's so much positive media at the highs, and that's what brings them in. Because the novice trader, they think the news is important. They think that whatever is happening in the news today is important. The smart investor is already in like 12 months before the news becomes a thing, all right? Because they're thinking like chess players. They're thinking into the future. They're using their forecasting muscles. So if the smart money, if we can agree the smart money is buying at the lows, that means they're buying from the dumb money. Now the smart money starts to make money as it goes up. Now imagine once you get past this previous all-time high here at $35. What is happening to the market dynamics here? The dumb money that sold, they are then kicking themselves in the ass, thinking, why did I sell? If I just held, I would actually be in a profit. Now, they might not buy yet, because they probably have a bit of ego thinking, no, I'm not going to buy. Like, oh, damn it, and they're trying to ignore it and think about something else. And then you get another run up, all right? You get a major, major move higher. And that's when they start to, think more and more like, oh shit, maybe I should come in. But then they start thinking, if I was already ran, I've already missed it. And then it goes again, right? It goes again. And then that's when they start thinking, oh shit, I should just probably jump back in now. And I'm going to learn my lesson. I'm just going to keep on holding for the future. I'm going to hold for the long term. That's what they're going to say to themselves. So that's like one part of the dumb money. Another part of the dumb money is thinking they've potentially watched the same thing happen, but they might have been too scared to invest. So they might have seen this previous run up in the past where the stock has been pumping and they've been too scared to invest, too timid. And then they see the stock price go down. And they're like, hey, see, that's why I didn't invest. They have that confirmation bias. That's why I didn't invest. But then it goes up again and it breaks out to the all-time high. And that's when they start second guessing themselves as well, thinking, oh shit, maybe I should get in too. And when it breaks out to all-time high, that's when the media starts to come out just a little bit, all right? Just a little bit. Because everybody in the history of that asset would be in a profit. That's a major news story, okay? And that's going to get a lot of clicks. So the way I like to think about it is, down at the lows, there's like no dumb money buying. That's all of the smart money. So down at the lows down here, that is all of the smart money. So let's put the smart money in blue. So the smart money is down here. Then the dumb money, let's put them in red. As it breaks out to all-time high, the dumb money is like this. They're like very small. Okay. Then as the price goes up, more and more media comes out, and also their FOMO, their fear of missing out, starts to kick in. So then they buy in more as well. So they're pushing the price higher. So the price is now starting to go up because it's supply versus demand because of the dumb money. It stopped going down because of the smart money at the lows. The smart money probably kept on buying to like all-time high, and then after all-time high, they're just chilling. But they would have got most of their position in at the lows, and they probably got their last investments at the all-time high. Most of them. This is generally speaking. Then that's when no one's really looking to sell yet. Why would the smart money want to sell? Because they haven't really made that much of a profit yet. There could be some people that want to sell at the all-time high. They're the really, really stubborn, dumb money who bought at the previous all-time high, and they're like, hey, I just do not want to. Walk away with a loss, so I'm going to just hold until it goes back. And I've learned my lesson. I don't want to play around with these stocks anymore, these individual stocks anymore. I don't want to touch NVIDIA anymore. It went down by 68%. I'm not touching anymore. Whenever I get back my money, I'm out of the game. So those are kind of like the last people to sell. That's why it's important to be a buyer when you break the all-time high, because it's like, who actually wants to sell? Who in their right mind would want to sell after you've broken the all-time high? Because you just smashed through that final people that are looking to capitulate and sell out of the stock, that dumb money that's really, really stubborn. All right. But now you got a new set of dumb money. They're buying, and they're buying small. They're still timid. As the stock price goes up, their confidence goes up. And so these circles that I'm drawing here are representing there's more money from the dumb money, and there's more of them. So there's more money and there's more of them buying. Okay. So then when you get near the highs here, this is practically where the dumb money who have started to buy at the all-time high, and halfway through the uptrend, they're in a profit now. So now they're telling, they think they're geniuses. They're telling all their friends and family, like, look how much money I've made. And they're getting to their own head as well, thinking like they're invincible now, like they're so smart, this is going to keep on continuing forever. Because this weird thing with us humans, like especially with pattern recognition, whenever we recognize a pattern, we think that pattern will happen again, right? So if let's just say this thing went up for a whole year, that's a pattern. This stock always pumps for a whole year. That means the next year is probably going to pump. That's how a lot of people think, but it's kind of like the opposite of that. Whenever something goes overblown too much, then it usually reverts back. Why? Because if a whole heap of people, dumb money, are buying at the top, yeah, then who is incentivized to sell then? It's the smart money who's up 10x and they start transacting, okay? Now, the stock price so far has been going sideways. It has been going sideways from that's June 2024. It's almost been going sideways for an entire year. This is where it gets tricky. Because if it has been going sideways for an entire year, that means by definition, the supply versus demand has been equal. So we have to be thinking, what is actually happening here? It could be that we're just consolidating here because we ran up too fast. All right, we ran up too fast and we just need to relax here and allow the internals of the company to catch up to this valuation. The valuation was overblown a year ago and we're just consolidating. Now, what can happen is we can consolidate for way longer, right? You can, in theory, consolidate all the way until you become cheap again on the other side, right? In theory, you can consolidate until January 2028, until, the year 2028. So you could consolidate for 2 or 3 years more and become cheaper. Stock market doesn't usually work like that. It does happen. It does happen where there are these 4 or 5 year long consolidations. It does happen. But usually there, with the stock market, it's just up and down, sellers versus buyers, okay? So that's one thing that could happen. Second thing is, which I wouldn't be surprised, is if we lose this key level, which is in the green horizontal, if we lose this key level and you break down below it, that would probably be the start of a bear market where the market would fall down more. That does not mean the stock is bad. In reality, fundamentally, the stock could still be strong. The profit could be going up. The revenue could be going up. Everything could be looking really healthy. But it could be because so many dumb money had bought in here. That means all of their buys are in at this level. If the smart money's, if they're taking too much profit and it outweighs the dumb money and it cracks the price down below that support level 88, that means everybody who had bought at the top is now in a loss, okay? They're now in a loss and they start to panic. And even if it looks small on the chart, in terms of what it says on their portfolio, if we measure from the top, if they literally bought the top, they're down 42%. Let's just give them the benefit of the doubt, which is like average. They probably bought, their average buys is probably roughly in the middle of this range from like 155 down to that 88 level. So it'll probably be in the middle, like around 120. So if that happens, they'll be down like 30%. It's still a lot. The reason why, let's just make the case and understand the market dynamics here. The average dumb money, if we do break below, I pretty much guarantee you that their average buy price, even if they started buying at the breakout, if they started buying the breakout at $40, right? If they started buying the breakout, the dumb money started buying the breakout at $40, in general, their average buy price somehow will end up being around 120, right there in the middle of that range, that top end range. Why? Because they don't go in with big conviction at the lows and at the times you should when no one's talking about it. Their conviction rises as the price rises, which makes no sense. That's why they buy small, because they're scared, they're really scared. They've been hurt in the past. They're scared to hit it big and invest big. Then it works. So it's like, you tell a dog to sit, you give it a treat. It gets rewarded for that positive feedback. Us humans, we're animals as well. Our brains work in a very similar way. So we press buy. That's the same as sit. We get rewarded for that action, for buying. Then it's likely we're going to likely do it more. So if we bought with this little circle here, with this little bit of amount of money, I'm like, hey, A novice investor would be like, hey, let's put in double the amount this time. If only I'd put in double the first time, I'll be up even more. But they're a little bit scared to do that. And then it shoots. And they're like, I should sell off another stock, right? And that kind of makes some stocks hold out. Some stocks might pause while this stock's going up even more. So then they come in even bigger, right? Even bigger. And eventually, they might have started like with a very small position, 1% of their portfolio. At the end, it turns out like it could be 30, 40, 50% of their portfolio is one stock now. Same as the dumb money, but their average buy price, because they went in bigger and bigger and bigger as the price went up, that's how they end up with their average buy price at 120. So then when it cracks the lows, who's the one that's going to fumble? The people who are going to fumble the ones into losses. Like, it's easy. Like, think for myself, if the price goes to $75, I'm chilling because I'm still in a great profit. My compound rate would still be very, very high, even if it breaks down to 75. But these guys, the dumb money who had bought in at 120, they might have been buying in. Like, if they've started buying in from 2023, after 2 to 3 years as it breaks down, they've bought in for 2 to 3 years. And after 2 to 3 years, yeah, the first couple years they had wins. Then on that last year, everything rolls over, and now the entirety of all of those actions of investing into that stock, now they're all in a loss. So now it's kind of like 3 years for nothing. Now it gets really scary. It's like, I've been investing so much money for 3 whole entire years and I'm down 30%. I'm down 30% after 3 years of doing something. And that's when your mind starts playing on you. And that's when people start to think, oh, should I sell or not? Should I sell or not? And some of these guys start to panic early. Sometimes panicking early is beneficial because what happens is a few of the dumb money start panicking early at 30%. Then some people are like, no, I got the diamond hands. I ain't selling at 30%. I'm just gonna hold forever. But then it like goes down again, and like they're down 40%. Then more people will panic because it gets too much, right? There's usually a level at which people will crack under the pressure and they will capitulate. So then more people will sell, right, at that level. Then when you come down to really, really cheap, it's like pretty much everybody is in a major loss. They could be all in a loss of like 50, 60, 70%. And that's when it's at peak fear. That's also when the news is bombarding you with like, hey, NVIDIA's dead. There's too much competition. There's going to be all these different stories out at that time, just like there was down at this last bottom, okay? That's when the sell orders are huge. They are huge. Now, you need huge sell orders because everything is supply versus demand. If there is not huge sell orders at the cheap prices, that means the smart money who has most of the money cannot buy. You need a lot of people to panic to sell, so then the smart people have enough to buy. Because imagine if a smart person wanted to buy, some cherries at the market, and there was like a singular cherry to be purchased, a singular share to purchase. Like, dude, he's not happy, is he? But imagine there was some sort of, people were panicking and they just wanted to get rid of their cherries, and the smart guy wanted the cherries. Now he can throw as much money as he wants at it and get as many cherries as he wants. Okay, so that's what happens. Now, if we think about the market dynamics of the smart investor, there could be two. There are going to be two different types of main demographic of the smart money. Let's go back to the original guy that we spoke about. The original guy, he was buying in at the lows down here, and he took some profits and he's locked in his future. Then, let's just say his money went like this. His money was this. Whoops. His money was this big when he bought NVIDIA. His money then probably became this big at the top. Let me just draw it nicely. His money became this big at the top. So then that's when he was in the position of like, oh shit, like there's a lot of money now. What I can do is literally sell off this much. Okay. Sell off this much, which is the same as that beginning amount, potentially even more. You might be able to sell 2 now because you might be able to sell 3 now because remember, this thing went up 10x. So he could have got 10 of his original money down here. So he could sell up 3, 4, 5. That's a lot of sells. That's what creates the top. That means, let's just say, whatever he sold, okay? He sold a few of these S's. That means his position he's holding is now smaller. So let's just, I don't know, for the sake of the video, let's just say he sold half. He's got 5 S's now that he's still holding, $5 signs. He's sold off 5, and I've only drawn 3 of each, but just bear with me. He sold off 3 to take profit, so he sold off this half, and then the price is back down here. So yeah, his 5 that he's holding from the top is not as profitable now, but he's got 5 free ones over here on the right side, which then he can use to buy the dip. And he can average in hard at the lows again and repeat the cycle. Okay? That's probably what that first demographic of the smart money is roughly thinking, something along the lines of that. Or they could just say, hey, I've already hit the lottery. I've already got my 5 free dollar signs. I've taken profits. I've been able to use that money to diversify into another asset. I've got 5x the money still in this stock than what I began with. I'm cruising. All right. I'm cruising. It will be less, it'll be less than after the dip because, it is after a correction. So they might only have one and double their money at that stage. But it's like they could have double their position and have taken off 5x the position as well and diversified with that. But that's one segment. The other segment is the smart money that's like, dude, I actually didn't do my job correctly. I actually missed out on this one. I had the discipline to not chase the FOMO. I had the discipline not to chase the FOMO, but I prepared in advance because in the grand scheme of things, even from back in 2016 when this bull market started, that's still pretty short. That's not even a decade, okay? Most stocks, they go for, if they're great stocks, they go for multiple generations, okay? Think about Google. Google has been pumping for its entire existence on the stock market. Amazon as well. It hasn't slowed down. These are multiple generational stocks. NVIDIA might be the same. Okay. So then they're thinking, yeah, these 2 to 3 year cycles, they're so small in the grand scheme of things. I missed out, but I'm gonna be disciplined, not buy in at the highs. I'm gonna wait for the correction. When the correction comes, I'm gonna buy in big. Okay. Now, that's kind of like that second demographic. To go a little bit more nuanced with the second demographic that missed out, let's break down and think about what they would be thinking as well. Remember at the start of the video where I was saying I don't actually know what's going to happen with NVIDIA. It can consolidate and it can keep going up. It can happen. All right, it can happen. All I know right now is the supply versus demand is the same. The sellers and the buyers is the same. Most likely that means the smart money is taking profits of some sort. They're taking profits of some sort. Now, at the start of the video, I was saying, if you don't have any allocation at all to these type of AI stocks, you are caught up in a bit of a pickle because if you don't invest anything at all and it does consolidate and it does shoot, like imagine if we get this, we consolidate for another year or so and then we create this range and then we break out and we go again. That can happen, right? That can definitely happen. And there's decent probabilities on that, okay? There's decently high probabilities on that because remember, this stock is actually a really great company. Revenue's going up, profits going up, everything is going pretty damn well. So if you're in that scenario, you probably have to think about, all right, what allocation and am I willing to invest today? As understanding it could be quite expensive and understanding it could correct down to these lows. How much will I invest? And if I believe that there is a higher probability that this can happen, then I need to invest such a small amount, right? Such a small amount of money that if I invest at these highs and it does correct, that I have more ready to go at the lows to average down and dollar cost average down to get my average buy price down. Do the opposite of what the dumb money does. I need to invest such a small amount of money that I can pull this off. But I can't invest too small that if it consolidates and just shoots up and runs again, then I miss out. So that's kind of like what the second demographic of the smart money is thinking in general. Now, see how we're kind of putting them in these demographics here, and we can kind of break them down and think how they would be thinking. If we can predict what the investor is thinking, and we can break down the different segments of the market participants, then that is all game theory. And then we're getting real life data, which is the stock price. If stock price is going sideways and it's already after a major run, any stock, that means the smart money is taking profits, right? Or they're not buying, because if the smart money was buying, the stock price would pump. Their money is huge. So think about the smart money like this. There's not many of them, right? There's not many of them, but their money is massive. Then think about the novice traders. There's heaps of them. They're the opposite. There's heaps of them, but all of their money is so small. But overall, there's way more people, but small money, but their money kind of can match, right? So it's like, heaps of novice traders with small money. Their money adds up to a certain size. There's not many smart money investors, but their money's big because they're all rich and their money matches. And that's how, these people, they're doing business with each other every single day. Every single day. It'll be funny, It'd be funny if there was an actual market. You can kind of picture it like the smart money would probably rock up in their nice suit and tie, rock up in their nice cars and all of that, hop out to this market, and then they'll transact with someone that's, not as sophisticated when it comes to this stuff. But it's funny, like, because like if imagine you could see the person you're transacting with, it would create a different feeling, right? Because you do actually have to think. If you're buying something and you think it's a great time to buy, someone's literally thinking the opposite. Someone's thinking, I want to sell. So, and there's only one person that's probably going to be right. One of you is either right or wrong, most likely. Okay. So, whenever, even in business, if you think, wow, I've got the steal of a lifetime on this business is so cheap. Why is the business owner selling that then? If the business is so great at that price, then why is he selling? You probably want to find that reason out, because it might be too good to be true. There's usually a sucker in the room. If you don't know who the sucker in the room is, it probably is you. That's the saying of the stock market. Okay. So, it's hard. One of the reasons why I can kind of understand this is there's a great book, Profiting in Bull and Bear Markets, by Stan Weinstein. He talks about the 4 stages. First stage is an accumulation, where the dumb money is panicking and the smart money is accumulating. Then a bull market starts to occur because the stock's actually good as it breaks out to all-time high. Then the dumb money starts to FOMO. As the dumb money starts to FOMO, that creates the liquidity for the wealthy to take profits and sell. That creates the stage 3 distribution. It's the smart money distributing. Then when it breaks down below that key level, in this case, it's $88. That's the start of the bear market. That's when the dumb money starts to panic sell, and it goes down and down further and further. The price goes way below the fair value. Remember, the fair value is usually somewhere in the middle of a channel, if there is a channel. Panics at the bottoms, which then creates the liquidity, all of the sell orders for the smart money to become a buyer again. And then that creates the accumulation, and you start the stages again. So what is it? It's stage 1 accumulation, stage 2 bull market, stage 3 distribution, stage 4 bear market, and then you start the cycle again. You accumulate the lows at stage 1, right? So that's how I know this type of stuff. Second of all, I do know this type of stuff because at one stage of my life I was the dumb money, so I just kind of I've been there. That's why you need like a diary. You need to be in your own head as an investor or a trader. I've been in there and I've analyzed everything that I do. I remember everything in great detail. Every mistake I made where I thought I'm going to be 100% right here, I've been there and done it. So I kind of think, what would the old Dylan do? What would the old Dylan do? Do the opposite of that guy. All right, everybody, that's everything for this video. Hopefully you learned something. Every great piece of content. Hopefully you liked it, and I'll see you in the next one.